You talked about how this is changing capital markets, changing inflation, and the whole like structure of the economy. Can you elaborate on tell the listeners what you think about that?
Yeah, sure. So historically, capital and demographics have not been intertwined. Now, yes, as you age, your net worth increases. And as you age, you become more adventurous with your investments, and that drives more economic activity. And then when you retire, you cash it all in and go to T-bills because you won't be able to stomach any sort of market turning or currency turning. That's been true since the dawn of recorded history. There's nothing new there. What is new is the demographic profile has changed. So in a pre-industrial world, you had very few 60 somethings. You had more 50 somethings and yet more 40 somethings and on down. It built a pyramid. What industrialization and urbanization has done is change the shape of the pyramid. In some countries like the United States, it's more or less a chimney, but with a bulge for the baby boomers. And
Hmm.
some like Germany, it's a diamond
Yeah.
with more people in their 50s than their 40s than their 30s than their 20s, and then
Yep.
narrowing up as you would expect at the top. What's happening globally right now, not just with the American boomers, is that we've got this big cadre of people in their 60s who are moving into retirement, and they are a bulge in the structure. So instead of just a small group of people relative to the overpopulation that are moving on and changing their investment portfolios, we have the single largest generation in our history doing that. And on average, they will have completed that transition by the end of this year. So we go from having some of the richest, most liberal, most open, most liquid capital markets we've ever known to something that's a lot closer to the opposite in less than a year.
But, with our financial repression that we've been going through for many years, I mean, this system has pushed people way farther out onto the risk curve in terms of their financial lives. You can't be 70, 75 years old investing in bonds or T-bills anymore, right? It just doesn't work. So you see these older people doing things that they shouldn't be doing financially. They shouldn't have to do, I'll put it that way, but they've got to earn some yield and they're
And
just,
and the first time you have a market turning, they become destitute.
yeah,
That's
right.
why most people don't do that. I agree
Yeah,
that there's a percentage of people that are, and that is unfortunate.
right.
And we're about to learn that good and hard because we're not just having this demographic turning, we're, of course, at the market tightening at the same time. And that's just
Mhm.
damnably inconvenient.
Yeah, but make sure we understand the link between inflation, capital availability, and the demographic situation. So baby boomers are retiring quickly. I mean, most of them are almost through the pipe. Well, I don't know. I haven't looked lately, but
Yeah,
you
the
can
midpoint is
elaborate
the
on
end of
this.
this year.
Yeah, say that again.
The midpoint is the end of this year.
Okay, so the midpoint of the baby boomers is the end of this year now, and then
Yes,
it trails off.
right.
And I don't know the stats, but something like 10,000 a day retire, or some number like that, or whatever.
It's some ridiculous
It's
number. I
it's
agree.
big, yeah.
Yeah, I mean, the problem here is we're losing the single largest worker cadre we've ever had. And
Okay,
the replacement generation down at the bottom of that pyramid, the
yeah.
Zoomers, they are the smallest generation we have ever had.
I'm
So,
sort
right,
of I'm sort of wondering why you identified, and you did that in the book, why you identified the Zoomers and not you didn't say just the next one down, which is my cohort, which I think might be yours too, which is Gen
yes.
X.
Well, Gen X
Um,
and millennials have been in the labor market already. So we're already
right.
factored into the math. Now, there's pros and
Oh,
there's cons,
okay.
and that
Yeah.
shapes a lot of things, but we are
Okay.
already in. The Zoomers are the ones who are coming in to replace
Yeah.
the
Sure.
boomers.
Okay.
And we have our largest generation going out, our smallest generation coming in. So right now, annually, that's 400,000 worker shortage. And that will increase every year until 2034 when it'll peak at 900,000
Okay.
shortage. And
So
these people are already born, they're already on the way. We know exactly what's going to happen to the net flows each and every year moving forward.
yeah, there's no mystery about this,
Yeah.
which is what I love about studying demography. And Harry Dent got me into that in the 90s. And ever since I've been a real, student of that idea, even though some of his predictions have been a little off. So he's been on the show 11 times and every time there's a bubble, but this time he's going to be right. I think we'll see. But what that does, what you just said, is that gives the bargaining power to the labor, not the capital, right?
The problem is that capital is going away at the same time. I
Oh,
certainly agree that the relationships are going to change. I
yeah,
think it's a little bit arrogant to think that I know exactly how,
yeah.
but we're definitely entering a period of protracted and extended and increasing labor shortage. At the same time, we're entering into a period of protracted and extended and increasing capital shortage.
Okay.
And just to make it a little bit more fun, China's collapsing against this backdrop. So
Yeah.
even if we decided we were fine with a completely globalized supply chain, we still need to double the size of the industrial plant in the next few years with less capital and with less labor.
Okay. So less labor would be inflationary because that would push wages up generally. But
I would
when you
argue
put,
that at the moment, the labor disconnect is the single largest issue behind our inflation numbers right now.